Stop scrolling for a second because what just happened in the silver market is not a headline event. It's a structural one. While most people were watching charts flicker up and down, a massive amount of silver quietly left the paper system and moved into real-world custody. Not traded, not rolled, not delayed, physically delivered and removed. And when that happens at scale, it's never random. It's a signal that someone somewhere no longer trusts the promises and wants the metal itself. This is the part most investors miss. Silver is not a price on a screen. It's a physical asset with a supply chain, bottlenecks, and limits. The market only looks calm as long as most participants agree to trade claims instead of ownership. Futures markets depend on that agreement. They work because the vast majority of contracts are settled without delivery. Paper circulates, metal stays put, and everyone pretends liquidity equals abundance. But the moment large buyers step in and say, "I don't want exposure, I want possession," the system is forced to reveal its stress points. It's like a quiet bank run, not caused by panic, but by calculation. The system doesn't break because of fear. It breaks when confidence quietly shifts and people act before the crowd notices. What we're seeing now is not normal flow. It's not seasonal noise. It's not retail speculation. This level of delivery only happens when institutions, industrial players, or state-level actors decide that access matters more than price. And once physical metal is removed, it doesn't circulate back easily. It changes the balance between what exists on paper and what's actually available. In this series, I'm going to walk you through what these delivery numbers really mean, why they matter more than daily price moves, who realistically has the incentive to act this way, and why small investors are always the last to be told the truth. We'll connect physical demand policy shifts, industrial necessity, and the fragile mechanics of the paper-silver market. Before we continue, do two things. Subscribe to the channel if you value original, independent analysis. And comment OG matters to support real research over recycled noise. Now let's move forward, because once you understand this first principle, you'll realize the silver market is already changing, even if the price hasn't caught up yet. To understand why this moment matters, you have to forget how most people are taught to view silver. The mainstream lens treats silver as a chart, driven by sentiment headlines and short-term macro noise. Rates move, silver reacts. The dollar shifts, silver follows. That framework is comfortable, but it ignores the real driver of this market: physical control. Futures exchanges function smoothly because most contracts never demand metal. They're rolled, netted, or settled in cash. That's not a flaw, it's the design. The system assumes participants want price exposure, not possession. As long as that assumption holds, liquidity looks endless and risk looks contained. The problem starts when that assumption breaks. Standing for delivery forces the system to perform physically, not symbolically. Specific bars must be located, verified, moved, and reassigned. Paper claims can multiply. Metal cannot. And when delivery requests rise outside of normal cycles, especially during traditionally quiet periods, it signals a behavioral shift, not random volatility. This is where retail and institutional thinking diverge. Retail investors watch price and wait for confirmation. Large players watch availability. They don't ask if silver's overbought. They ask whether supply will be there when they need it. When that question becomes uncertain, hesitation disappears and accumulation accelerates. Price is the public narrative. Delivery is the private one. And right now, the private story is getting louder, even if the chart hasn't fully reacted yet. In the next chapter, we'll confront the real issue this raises: who has the incentive and the ability to remove silver at this scale, and why that answer is far more revealing than most people expect. Once you ask who is capable of removing silver at this scale, the list becomes uncomfortably short. This is not retail behavior. Even during peak enthusiasm, small investors simply do not stand for tens of millions of ounces in a matter of days. This is not coin shops restocking. It's not a fund making a tactical trade. The logistics alone eliminate most participants. Moving that much metal requires planning capital, storage, security, and a reason that goes beyond short-term price action. That leaves three realistic categories of buyers: governments, industrial giants, and large financial institutions acting with strategic intent. Each has a different motive, but they share one common trait. When they act, they do it quietly and early. They don't wait for headlines or public validation. They move when access is available, not when the story is popular. The most uncomfortable possibility is that this isn't one buyer at all. It's multiple informed players responding to the same set of signals. In markets, the most violent moves don't begin with panic. They begin with coordinated repositioning by those who see a shift in risk. When that happens, demand doesn't rise smoothly. It stacks. This is also why mainstream financial coverage misses the story. Media focuses on price because price is visible. Ownership is not. You'll hear discussions about volatility technical levels or speculative interest, but rarely about who is removing metal from circulation. That conversation forces a harder question: what happens if the system is asked to deliver faster than it comfortably can? This doesn't mean collapse is imminent. It means vulnerability has increased. The futures market can manage paper claims easily. It becomes sensitive when physical performance is required repeatedly. And that sensitivity grows as more metal is taken off the table and locked away. In the next chapter, we're going to explain why this vulnerability exists in the first place by breaking down a mechanism most people have never heard of, but everyone depends on the reuse of the same metal across multiple promises. The vulnerability in the silver market comes down to a concept that sounds complex but describes a very simple risk: the same ounce being promised more than once. In financial language, this is often called rehypothecation. In plain terms, it means multiple claims exist on the same underlying metal because the system assumes most people will never ask for it at the same time. Think of it like a parking space rented to several drivers because the owner believes only one will show up. On paper, it works. In practice, it only works until demand overlaps. The paper-silver market is built on this same assumption. Futures contracts, ETFs, swaps, and synthetic products all reference silver without requiring the metal to move. That creates liquidity volume and the appearance of abundance. The illusion holds as long as confidence remains high. As long as participants are satisfied trading claims, not ownership, the system looks stable. But the moment a meaningful number of holders decide they want delivery instead of settlement, the structure is tested. Not because silver doesn't exist somewhere in the world, but because deliverable silver, in the right form at the right place on the right timeline, is a much smaller pool. This is why delivery pressure matters more than price. Price can be managed with leveraged narratives and time. Delivery removes time from the equation. It forces real-world logistics to match financial promises. And when promises stack faster than metal can move, stress appears quietly, long before it shows up in headlines. This is also why comparisons to redemption events are so useful. Funds that offer daily liquidity while holding illiquid assets look fine until redemptions accelerate. Then reality asserts itself. The silver market operates on a similar principle. Paper flows are easy. Physical flows are not. In the next chapter, we'll explore why this pressure is emerging now, and how quiet policy shifts and supply realities are pushing silver out of the commodity bucket and into something far more strategic. The delivery pressure we're seeing didn't appear out of nowhere. It's happening alongside a series of quiet shifts that are changing how silver is viewed at the highest levels. Silver is no longer treated as just another industrial input or a speculative metal. It is increasingly framed as a critical material essential to systems modern economies cannot function without. Silver sits at the core of electronics, energy infrastructure, advanced manufacturing, and defense applications. When a material is labeled critical, the mindset around it changes. It stops being something you source opportunistically and starts being something you secure deliberately. Governments and large institutions don't ask whether the price is attractive. They ask whether future access is guaranteed. At the same time, global supply chains are becoming more fragmented. A significant share of refining capacity is concentrated in a small number of regions. When those regions prioritize domestic needs or adjust export rules, supply doesn't disappear, but availability does. The silver may exist, but it becomes harder to access on global terms. This is where small policy adjustments have outsized impact. No bans are required. No dramatic announcements. Slowing the flow is enough. And when that happens, in parallel with rising industrial demand, pressure builds invisibly. Large buyers don't wait for confirmation. They move early, lock in supply, and remove uncertainty. That context explains why physical delivery demand is rising now. It's not speculative enthusiasm. It's strategic behavior. Buyers are positioning for a future where silver is not freely available at any price on any timeline. And once silver is viewed through that lens, it stops behaving like a normal commodity. In the next chapter, we'll quantify what this really means by looking at scale logistics and why movements of this size are never casual or accidental. Numbers like tens of millions of ounces sound abstract until you translate them into the real world. Moving silver at this scale is not a click of a mouse. It involves transportation, secure storage insurance, and coordination across multiple facilities. This is not something done on impulse. It requires planning, intent, and a clear objective. When metal is taken for delivery, it has to go somewhere. Vault space must be arranged, security protocols activated, logistics scheduled. These are the actions of buyers who expect to hold the metal, not flip it back into the market. That alone tells you this is not short-term speculation. This is where the question of government involvement naturally arises. No accusations, no theories, just pattern recognition. The behavior matches what you would expect if a state-level actor or a state-connected institution were quietly building or replenishing strategic reserves. Using established market mechanisms is the cleanest way to do that. It looks ordinary on paper, even if the scale is extraordinary. Industrial giants also fit this profile. For manufacturers that depend on silver supply, interruption is not a pricing problem. It's an operational threat. Production lines don't pause politely. Contracts don't wait. When reliability comes into question, companies secure feedstock directly, even if it means paying up and holding more than they immediately need. This kind of front-loading behavior is rational. Running out of silver can halt entire operations. Holding extra inventory, by contrast, is cheap insurance, and once one major buyer acts, others tend to follow. Nobody wants to be the last one trying to source material in a tightening market. In the next chapter, we'll examine how this sets up a collision between industrial demand, financial demand, and government interests, and why retail investors are almost always the last to feel the impact. This is where the real tension in the silver market begins to form. On one side, you have industrial demand that is non-negotiable. Manufacturers don't buy silver because it's cheap or fashionable. They buy it because without it, production stops. Electronics, energy systems, medical devices, and critical infrastructure all depend on a steady flow of silver. That demand does not disappear when prices rise. It adapts by securing supply earlier and more aggressively. On another side, you have financial demand. Investors move when they sense imbalance. They don't need silver to operate a factory, but they do need protection against currency erosion and systemic risk. When physical supply tightens and delivery stress rises, investment demand doesn't fade. It accelerates because the narrative shifts from opportunity to urgency. Then there is the third layer: governments. When silver is viewed as strategic, it stops competing purely on price. It competes on priority. Domestic needs come first. Stockpiles matter. Access matters. And once governments enter that equation, the free-floating global market becomes smaller than most people realize. Retail investors sit at the bottom of this stack, not because they're uninformed, but because they arrive last. By the time headlines turn bullish, easy supply is already spoken for. Premiums rise, availability tightens, and what looked cheap in hindsight suddenly feels unreachable. This is not emotional, it's structural. Commodity cycles always reward those who understand the flow early and punish those who wait for comfort. In the next chapter, we'll explain why silver's supply structure makes this collision far more dangerous than it appears on the surface. Silver's supply structure is the hidden accelerant in this story, and it's the reason pressure builds faster than most people expect. Unlike gold, silver is not primarily mined for its own sake. A large portion of global silver supply is produced as a byproduct of mining other metals. That means supply does not respond cleanly to price. If silver demand rises sharply, producers cannot simply flip a switch and flood the market with new ounces. This rigidity matters. In most markets, higher prices eventually attract more supply and cool things off. In silver, that feedback loop is slow and imperfect. Copper miners don't double production just because silver prices improve. Lead and zinc operations don't expand overnight. So when demand increases, especially physical demand, the system absorbs the pressure rather than releasing it. At the same time, silver behaves differently on the demand side. Much of it is consumed in tiny amounts across millions of products. Once it's used, it's often uneconomical to recover. Gold tends to sit. Silver disappears. Over time, that creates a quiet drain on above-ground inventory, even in years when prices appear stagnant. This is why silver moves in bursts. Long periods of calm are followed by sharp repricing episodes. It's not random volatility, it's stored tension finally expressing itself. When inventory's thin and delivery demand rises, the market doesn't adjust smoothly. It snaps to a new level. This is also where the bubble argument falls apart. Bubbles are driven by belief and collapse when belief fades. Repricing events are driven by reality and stabilize when price finally reflects scarcity. Silver's story right now is rooted in structural deficit supply, rigidity, and strategic demand, not crowd psychology. In the next chapter, we'll connect this directly to currencies and explain why silver's movement often says more about money losing value than metal gaining it. To fully understand what silver is signaling, you have to zoom out and look at the currency layer beneath everything. Most people are told the dollar is strong because it rises against other currencies. But that comparison misses the point. Measuring one weakening currency against another doesn't tell you much about purchasing power. It only tells you who is weakening more slowly. A better question is simple. What can your money actually buy? When you measure currencies against real assets like silver and gold, a different story emerges. Over long periods, it's not metals that become wildly more valuable. It's currencies that quietly lose their ability to hold value. Silver doesn't shout this truth. It reflects it. This is why silver often moves in ways that confuse traders. It's not reacting to daily news. It's responding to long-term dilution. When confidence in money erodes even gradually, hard assets don't need hype to perform. They only need to remain scarce while currency supply expands. This reframes the entire narrative. Instead of asking why silver is rising, the better question becomes why money is buying less. In that context, delivery pressure takes on a new meaning. Large players aren't chasing gains. They're managing risk. They're reducing counterparty exposure. They're stepping outside a system built on promises and into assets that don't require trust. This is also why the paper silver market is so sensitive. Price can be influenced with leverage and stories. Delivery cannot. When buyers insist on possession, they are voting with action, not opinion, and that vote is happening quietly before the public conversation catches up. In the final chapter, we'll bring everything together. We'll extract the strategic lessons from this moment and translate them into clear practical guidance for anyone trying to navigate a market where reality is beginning to overpower narrative. Let's bring everything together and focus on the lesson that actually matters. What's unfolding in the silver market is not a short-term trade and not a speculative craze. It is a structural shift driven by physical control, strategic demand, and growing stress inside a system that was never built to deliver large volumes of metal repeatedly. This is how repricing stories begin quietly before the public notices. The first lesson is simple but critical. Price is not the signal behavior. When major players stop accepting paper exposure and start demanding physical possession, they are revealing a loss of confidence in promises. They are choosing certainty over convenience, access over optics, ownership over trust. That behavior change matters far more than any daily candle. For small investors, this is not about competing with governments or industrial giants. That battle is already decided. The real advantage you have is awareness and discipline. You can pay attention early. You can ignore emotional headlines. You can build exposure deliberately instead of chasing confirmation. Silver is not a lottery ticket. It is a strategic asset that protects against supply risk, currency erosion, and systemic stress. The second lesson is patience. Repricing events are rarely smooth. They come with volatility pullbacks and narratives designed to shake conviction. That noise is not proof the thesis is wrong. It is the cost of positioning before reality becomes obvious. Finally, focus on the signals that matter. Delivery behavior, inventory movement, policy language around critical materials, industrial procurement trends. Be skeptical of stories that talk only about price while ignoring physical flow. When mainstream coverage finally turns enthusiastic, it will not be early. It will be late. If this analysis added value, subscribe so you do not miss what comes next. Hit the like button to support independent work and comment with the signal you are watching most closely. The silver market is changing. The only real question is whether you will recognize it before the crowd is forced to.